Mr. Alok Churiwala is a third generation stockbroker and an angel investor. He holds a bachelor's degree in commerce from HR College of Commerce and Economics, Mumbai. He also holds a diploma in securities law from the Government Law College, Mumbai. He has a rich experience of over 20 years in the Indian capital markets. Churiwala Securities Private Limited is spearheaded by Mr. Alok C. Churiwala. Besides being an ex-member of the BSc governing board, he has been actively involved in various committees of the exchange. He is a much sought after visiting faculty offering lectures on a wide spectrum of subjects relating to capital market in India. He is widely quoted in various business publications like Economic Times, Business Standard, the Lal Steel and Financial Express, and television media like NDTV Profit, Doordarshan, Zee Business, Star News, Sahara, BBC, CNBC, CNN, IBN, Channel 7, etc. He is currently Vice Chairman of the BSc Brokers Forum and regarded as an industry spokesperson. So, sir, what do you think? What are the objectives behind investment?
There are several reasons why an investor invests. Primary among them is saving of your disposable surplus. Today, an investor who is otherwise involved in other profession, business, other gainful activity, he will use a part of that disposable surplus to save in the markets. The other reason why investors generally tend to save is safety of capital. Today, whatever capital that we so allocate for our savings, we have to keep it aside and we have to ensure that that capital is extremely safe. One of the other objectives of investment is we have to continually beat inflation, because today inflation moves up at such a high pace. If we see, the rate of inflation is almost anywhere between 8 to 10% per annum, and if our saving is not large enough, or if the return on our saving is not large enough to beat inflation, in real terms the value of our money is diminishing over time. Also, what investors must remember is that they must save in such instruments that ensure liquidity is available when it is required. Today, as there is an old adage that says, save for the rainy day. We don't know what that rainy day might be. That rainy day might be emergency hospitalization that is required. And at that point in time, if your investment is not giving you the kind of liquidity when you need it, then your investment is quite worthless, because bird in hand is worth two in a bush. Also, last but not the least, an investor also has to ensure that the place where he is saving is giving him adequate tax planning. It is efficient as far as taxes are concerned. The amount of taxes that he or she is paying is reduced by the kind of investment avenue that he chooses for himself or herself.
Sir, can you please tell us what are the major avenues of investment?
There are several avenues of investment and each one has their pros and cons. I will briefly elucidate and touch upon each point. First and foremost, there is equity. Equity has its own pluses and minuses. In equity investments, the returns are very good, but also we must understand with every return, there is a four-letter word attached, which is risk. So in equity investments, the investor should understand there is an element of risk involved. However, risk is involved in every aspect of our life. Even when we are walking on the road, there is a risk of being run over by the car. But what is the risk management that we do? The risk management that we do is we walk on the pavement instead of walking on the road. Not to say that some car will not come and knock you off the pavement, but the chances are fewer. So the moment we learn to manage our risks and invest, we have minimized risk. Investors should please understand that risks can always be mitigated but never eliminated. Next in line are debt funds. Debt, as you know, your capital is generally preserved. There is no diminution of your capital and you get a fixed rate of return from time to time. Now, that fixed rate of return may be attractive, may not be attractive, but here also the adage of high risk, high return is there. So if a company or an instrument is offering you higher return, I think the investors can be very well sure that the risk profile attached to that instrument would be slightly higher. Mutual funds for the small investor, I think, is one of the best vehicles for investment. What are mutual funds? Let's briefly touch upon what mutual funds are. Mutual funds are where collective pool of investment accumulated from small investors like yourself who don't have the knowledge or time to approach markets directly. So the moment you go through the mutual fund route, there will be a mutual fund company, there will be an asset management company which will have a fund manager who will manage your funds. These are hardcore professionals who understand the vagaries of market, and mutual funds could be of various types. Mutual funds could be, some mutual funds would be equity, pure equity, some would be pure debt, some would be a hybrid of equity and debt, which are known as balanced fund, some would be sector specific funds, some could be index funds. So there are types and types of mutual funds which, when taken advice from your financial advisor, he will guide you as to which is the mutual fund which is best suited for your objective and for your investment. Yeah. Bullion. Every Indian understands the luster and the advantage of gold, because over generations they know that the price of gold has been continually moving up. In fact, the exchange of gold in every wedding has ensured that everyone has kept a track of the prices of gold. The gold that perhaps the grandfather bought, the same prices were not available to the son, nor will the prices the father has bought gold at will be available to the grandson. So the utility of gold is understood by one and all. In fact, there are several pluses and minuses. We will come to that a little later, but then we come to the favorite category of all, which is real estate. Real estate investments have over the last 30-40 years given stupendous returns, perhaps equaled only in some measure by equity. But real estate investments also have their pros and cons. Some of the cons of real estate are, some of the disadvantages of investing in real estate are that the ticket size is very large. Today, if you want to invest a few thousand rupees, real estate is obviously not the place where you will be able to invest. Real estate is extremely illiquid. So there again, real estate, there is a problem, because you may not realize the value of your real estate, and assuming you have tons of money, you have the ability to hold on for a longer period of time, the real estate market is very illiquid. So when you want the money, you may not be able to get it. Add to that the cumbersome paperwork and the high entry and exit costs. Today, currency or staying in cash is also a real option. But when you say staying in cash, as and when India becomes fully convertible, investors should understand that they will have the option to keep their cash in certain currencies, whether to keep it in Indian rupee or to keep it in US dollar or to keep it in the euro or to keep it in Japanese yen. These will all be options available to the investor where they can put their money in. As you move up the value chain, there are art and other collectibles which can be used as an avenue for investment. But again, they have their own vagaries, which we shall discuss about later.
Sir, can you please throw a descriptive light on each avenue so a clear picture is in front of us? Sir, can you please elaborate on equity?
Now, let me briefly discuss the advantage of equity investments. Firstly, the know-how of the company is extremely essential. Now, how an investor goes about getting that know-how of the company? One is to read oneself about it. But if someone doesn't have the time, effort or understanding of the subject, professional help is always available. I think investors should not shirk from using professional help. Equities, like we discussed earlier, are high risk, high return products. Risk can be mitigated or minimized by understanding what the risk is. When we invest in equity, there are two things that an investor can expect. One is, if the company is a profit-making company, the company could give dividends. But please understand, dividends are declared only out of profits of the company, and such profits of the company that the company may not need for further expansion of itself. So there are times when a company is making good amount of profit but chooses not to pay dividend to its investors because they may want to invest the same money in itself for future expansion. The second thing which is very dear to investors is capital appreciation. So capital appreciates, in other words, it means the value of your stock or the stock price goes up. So a share that you may have bought at 10 rupees may go to 100 rupees, may go to 1000 rupees, or the value of that investment may go extremely high. Just to give you an example, 10,000 rupees invested in somewhere in late 70s, today would you guess how much it would have become? Did I hear a few lakhs? Did I hear tens of lakhs? Friends, it could in certain companies be worth more than a few crores. Shocked? Yes, but that is what equity investments are all about. That certain companies, if the companies are good, if the managements are good, the business that they are doing in is stable, can give you these kind of returns. Also, what we have to see is how tax efficient is our investment. Today, equity investments are extremely tax attractive because if you are holding an equity share for long-term purposes, if you are holding an equity share for more than a period of year, whatever gains that you might get thereon are completely tax-free. So that is a big advantage. Herein, I must give a word of warning. Equity investors, everyone calls themselves an investor. They tend to lose focus as to who they are, whether they are an investor, a speculator, a trader. There is a distinct difference between a speculator, a trader, and an investor. An investor is someone who puts in his hard-earned savings, puts it in, waits for long term, and hopes to get a return. Whereas a speculator is someone who takes a call, who takes a wager that the stock price will go up within a short period of time and wants to make money. A speculator generally trades on margin. He does not pay 100 rupees for the 100 rupees worth of shares that he is buying. He may perhaps pay only 10 rupees for the 100 rupees of shares that he is buying. And traders, as you know, could be intraday traders, intra-week traders. For them, it is a business activity that they do. Not to say that you should not speculate, you should not trade, but an investor should know exactly what he is doing and why he is doing. IPOs, secondary markets, mutual funds, these are all ways how you can enter the equity markets. So friends, please do enter this world of equity investments and see how it works for you.
So please throw a descriptive light on debt.
Now we'll briefly discuss some of the characteristics of debt investments. Investing in debt is generally a passive form of investment. It gives you consistent returns, but while providing you consistent returns, it also gives you a higher degree and safety of capital, which is what is suited to most investors. Also, we must understand that a lot of investing that we do depends upon the life stage that we are at. So a young investor who is at the beginning of his career may have the need to preserve his capital. He does not have the ability to take a lot of risks. So debt may be a useful mix in a portfolio, whereas the component of equity may be that much lower. Whereas even when an investor has reached a superannuation age, the propensity to take risk for that type of an investor generally becomes lower. Hence, once again, debt takes center stage and an investor may prefer to invest in debt. However, while investing in debt, it is always seen that it is generally low risk, low return. What one could benchmark oneself to a higher return by taking a higher degree of risks. But that could be either in instruments that are not optimally rated or companies that are suboptimal. Then some of the instruments herein are bonds, gilt-edged securities, mutual funds who offer a varying degree of debt. There could be pure debt funds or there could be balanced funds. Of course, the most favorite of all investors, which is the bank fixed deposit, post office savings schemes, the national savings scheme, and intercorporate deposits. Intercorporate deposits are generally used only by the corporates.
Sir, can you tell how the mutual fund basket works?
Mutual funds are collective pools of investments. They are generally used by people who do not have either the time, effort, or the propensity to manage their own funds. So, funds are collected from investors, put in a common pool, given to a company to manage. It is generally managed by professionals who have extremely deep understanding of the markets, who have all access to all the tools of the trade. Now, what you may say, what are the tools of the trade? Today, for an investor to be able to invest ably, he should have access to the latest information, to the latest research, and the best of technical and fundamental analysis. When all this is at the disposal of a professional who understands market, chances are that the result that you will get from the investment of your funds will be much better. One of the easy options of investing in mutual funds is the index fund. First of all, let us briefly understand what is an index. An index is a basket of stocks. It could be either 30 stocks, which is the Sensex, or it could be a basket of 50 stocks, which is the Nifty, or it could be a basket of bank stocks, which is the BankX. So it could be a basket of stocks which the mutual fund mirrors in their investment, and an investor can get easy access to investment in those. So if an investor feels that the future of banking industry is good, he can go in for buying a bank index, and he has to do nothing further. The fund manager will mirror the index in the same proportion as the stocks that are there, and when the index goes up, the investor can sell and make money. Similarly, Sensex and Nifty also have index funds which an investor can go in for.
So please throw a descriptive live on bullion also.
Bullion, this hardly needs any explanation because Indians have been known to love gold. They have been understanding the value of gold since times immemorial. So much so, once upon a time, our country was known as the golden bird, or in Hindi, Sone ki chidiya. This has been the ultimate favorite of investors. It is extremely simple to understand. Even the woman in the village, rural India, understands the value of gold. So people don't think twice before investing in gold. But there are several disadvantages to investing in gold, which I will elucidate. One is risk of storage. Yellow metal has always been the object of envy. So how you store it, where you store it is a big problem. You not only have to keep it away from your friends, neighbors and thieves, but sometimes even from your own family members. Second is purity. Today, for an average lay person, it is extremely difficult to gauge what the purity of the gold that we have purchased it, for which we have to go only to a jeweler and hope and pray that the jeweler is honest and will give us the right opinion. Of course, gold has universal appeal, but let me put a word of caution whilst investing in gold. While investing in gold ingots, exchange traded funds and futures are products that you can put your money in. Investing in gold jewelry may not necessarily be a wise investment. Why, will you ask? Simple. The moment you turn gold ingots into jewelry, you have to mix alloys. So that reduces the purity, plus you have to add making charges. So in your times of need, when you go to sell that product, chances are you will not get the same value out of it. So if you are buying gold as an investment, my suggestion is go in for gold ingots, or better still, the exchange traded fund. An exchange traded fund is a product which stores your gold in demat form. There is a mutual fund which buys that gold and keeps it in a vault, so you don't have to worry about the safety and security or purity of it. And since it is in the demat form, your attachment does not build up, and as the value of gold goes up, you can sell it and make profit on it. Please understand that on an ETF, no STT is charged, and if you sell it after 1 year, it is capital gains tax free. So even it is a very efficient tax product.
And sir, of course, real estate.
Real estate is a type of investment that has worked very well in the Indian context. If you see, the prices of real estate have been going up over the decades, but there are several complications and disadvantages to putting money in real estate. First and foremost, the ticket size. There is an entry barrier. When I say ticket size, the amount of money that you have to start with to purchase a property is very large. Plus, the laws of the land are extremely complicated, which deter the lay person, even if he has the money, from investing in land. Third, there are state-wise restrictions on who can purchase, how much can be purchased. For instance, in the state of Maharashtra, agricultural land can be purchased only by an agriculturist who is originally from the state of Maharashtra. So, various states in various parts of the country have different laws. The paperwork is extremely complicated. The ability to get in and out of a transaction quickly is not there because the market is not very liquid. So, while it is an investment that pays you very well, it is a very difficult proposition for most Indians. However, of late, there has been easy availability of home finance for home users. That has led to a lot of people investing in first and second homes. And because of the fact that inflation has been present in the Indian markets, the prices of real estate have been going up over the years. One product that we are all looking forward to is the real estate investment trust, which are popularly known as REITs, which are nothing but mutual funds in the real estate space. They are yet to come and or yet to take off in the proper context, but as and when they come, the small investor will have the opportunity to be investing in real estate.
And last but not the least, art and other
collectibles. This is for the extreme savvy investor, an investor who has otherwise fulfilled all the other baskets of investments. I repeat once again that all the avenues of investments are essential. Every investor must apportion their money in all of them depending on the age, depending on the investment objective, depending on the risk profile of the investor. So art and other collectibles come at the very top of the pyramid. They are extremely illiquid. Not everyone can appreciate the value of art and collectibles. The transaction costs are very high. Like for instance, to give you a comparison, in equity shares, while the transaction could be in basis points, when you go to buy an expensive painting of an M.F. Hussain or a Raza, it might cost, the broker or the art dealer might charge you 30% of the transaction value. So it is extremely high transaction cost. Specialized knowledge of that art form is necessary. They are not liquid and the deals are generally not transparent in nature. So while for people at the top of the pyramid, they make excellent investments, but for the lay investor, I do not recommend these. Here I have showcased what a typical high net worth individual would be investing in, and while this may be representative, this is not, let me add, a prescription of how investors should invest. Typically, an investor may have about 40% of his wealth in real estate, 20% in debt, 10% in equity, 10% in mutual fund, 10% he would like to keep cash or currency available, 8% in bullion, and 2% art and others. So this is what a typical allocation of wealth would look like for an individual. Last but not the least, I will say, always remember, choose the ideal product mix as per your investment goals and temperament. Each one of us is built differently. We are all different individual, mostly having common needs. Some of our needs are common, but each one is a different individual. So our investments also have to reflect our personalities. Do not go by hearsay. There will be a lot of people who will say a lot of things. I think it is best to seek professional advice. When we have a tummy ache, who do we go to? We go to the professional, who's namely the doctor. We take his professional advice. We generally know the prescription he's going to give, but we still prefer hearing it from the professional's mouth. One size does not fit all. This is not a boutique store where you can go pick up a t-shirt which will fit all. Each individual, like I said, is built differently, and you have to take advice, you have to take opinions as per what your goals and needs are. Last but not the least, always take expert advice, guidance and assistance, for which professionals are standing by to be of service to you. So friends, we've seen that there are several avenues of investment that are available to us. Now it is up to us how we make the most of it. And on a concluding remark, let me say, the man who is a bear on the future of India will always go broke. Happy investing.